Silver went from $29 per ounce to $121 per ounce in the space of approximately 13 months. That is a 317% gain in 13 months. And yet the vast majority of people who were sitting in the silver market during that entire run, people who had been stacking for years, people who believed the story, people who understood the thesis, did not capture anything close to the full return. Some of them sold too early. Some of them panicked during the correction and sold at a loss. Some of them owned the wrong form of silver and got hit with costs and spreads and counterparty risks they never accounted for. Some of them put their entire position in one form of silver exposure and watched it get wiped out during the January 2026 flash crash, while physical silver holders were completely unaffected. And most of them, if they are being completely honest, made at least one of three specific mistakes that cost them a significant portion of the return they should have captured. I have spent years studying the precious metals market. I have watched the cycles. I have watched the mistakes. And I want to tell you today, before the next bull run, while the price is sitting at a discount to the recent high, while there is still time to position correctly, what those three mistakes are. Because the next move in silver is not going to give you a second chance once it starts, and most people will make the same mistakes again unless someone tells them what those mistakes actually are. Let us start with the first mistake. The first mistake silver investors make that keeps them broke is this: they confuse paper silver with real silver. This is the single most expensive error in the precious metals space, and it is extraordinarily common because the financial system has built an entire infrastructure designed to give you silver exposure without giving you silver. Silver ETFs, silver futures, silver certificates, unallocated silver accounts at banks, silver CFDs, mining stocks with silver exposure. All of these instruments are described as ways to participate in the silver market. And in rising markets, they mostly do what they say they do. They go up when silver goes up. But they are not silver. They are promises. And promises behave very differently from silver during the moments that matter most. On January 29, 2026, silver hit $121 per ounce, and then over the following days and weeks it crashed violently. The ProShares Ultra Silver ETF, a leveraged paper silver instrument, shed 20% in a single session on one of the worst days. The iShares Silver Trust ETF fell more than 4% in a single day multiple times. Silver mining stocks like First Majestic Silver and Core Mining dropped more than 6% and 5% respectively in individual sessions. And people who held these instruments, believing they owned silver exposure, got margin called, got stopped out, got panic sold by algorithms and fund redemption pressure that had nothing to do with the physical silver market. Meanwhile, people who held physical silver in private storage, coins, bars, rounds, watched the price charts with mild discomfort and did nothing. Because you cannot get a margin call on a silver coin. Nobody can force you to sell your physical metal at the worst possible moment. The paper market drama was entirely irrelevant to anyone holding the real thing. And here is what makes this even more important in the current context. ING Think published research earlier this year revealing that U.S. tariff uncertainty had already pulled significant volumes of physical silver from London to the United States, triggering a historic squeeze in the London silver market, the world's primary silver trading hub. Available silver stocks in London declined sharply. Physical premiums, the amount above spot price that buyers were paying for real metal, remained elevated even when the paper price was falling. The physical market and the paper market were telling completely different stories simultaneously. Paper silver, crashing. Physical silver premiums elevated. Demand strong. The people holding paper silver experienced the crash. The people holding physical silver experienced the reality, which was that real metal in hand was being sought, moved across the Atlantic, and premium priced even as the futures chart was going down. This is why the distinction between paper silver and physical silver is not a minor technical detail. It is the difference between owning the asset and owning a derivative of the asset during the moments when the distinction matters most. The first mistake is believing that paper silver is real silver. It is not. Sell the paper, buy the metal. Now the second mistake. The second mistake silver investors make that keeps them broke is this. They stack silver, but they have no conviction. So they sell at exactly the wrong moment every single cycle. This is not a market knowledge problem. It is a psychology problem, and it is more damaging to long-term returns than almost any other factor. Here is how it plays out. A person hears the silver thesis, the supply deficit, the industrial demand, the monetary case, the historical returns. They get excited. They buy some silver. They feel smart. They tell their partner, their friends. Maybe they post about it. Then silver corrects. It goes from $20 to $16. They feel uncomfortable. They start questioning themselves. Was the thesis wrong? Did I misunderstand something? Maybe I should wait until it stabilizes. And then it corrects more. 16 becomes 13, and the discomfort becomes acute. Maybe I should sell now and buy back lower. They sell at 13. Silver then goes to $49. They watch from the sidelines. They feel sick. They tell themselves they will get back in on the next dip. But there is no comfortable dip. Every dip feels like it might go lower. Every rally that they miss makes the next entry feel more dangerous. And so they wait and miss the entire move. This exact story has played out in the silver market in 2008, in 2011, in 2020, in every cycle. The people who sold at the bottom of the correction missed the move. The people who held, even if they held uncomfortably, even if they questioned themselves every single day, captured the full return. What separates the holders from the sellers is not better market timing. Nobody has better market timing consistently. What separates them is conviction, a genuine, deep understanding of why silver goes up that is robust enough to survive the correction. And conviction comes from understanding, not from hope. So let me give you the understanding you need to hold through the next correction. Silver is in a structural supply deficit for the 6th consecutive year in 2026. That means the world is consuming more silver than it mines every single year. Mine supply cannot respond quickly. Most silver is a byproduct of other metal mining, and major silver projects take 10 to 15 years from discovery to production. The deficit is structural, and it is deepening. Industrial demand is growing from multiple directions simultaneously. Solar panels require silver with no adequate substitute. Electric vehicles require silver. AI data centers require silver. Medical technology requires silver. Defense systems require silver. None of these demand categories are cyclical trends. They are structural megatrends measured in decades. Germany just removed silver from its own coins because it is too scarce and too valuable to use in face value tokens. Russia is running a multi-year strategic plan to accumulate $535 million of silver as a state reserve. JP Morgan projects silver to average $81 per ounce in 2026, more than double the 2025 average. If you understand these facts, genuinely understand them, not just know them as talking points, but understand them at the level where a correction does not shake them, you will be able to hold through the discomfort. and holding through the discomfort is how you capture the full return. The second mistake is stacking without conviction. The solution is not more discipline. It is deeper understanding. Now the third mistake. The third mistake silver investors make that keeps them broke is this. They think about silver as a trade instead of as a monetary principle. This is perhaps the most subtle of the three mistakes, and in some ways the most important. A person who thinks about silver as a trade is always asking the same question: when should I sell? They bought at $20, and they are watching the price every day. When it hits $40, they start thinking about taking profits. When it hits $60, they are certain they should have sold at $40. When it hits $80 and then corrects back to $60, they are furious at themselves for not selling at $80. And by the time it reaches $100 and then crashes back to $70, they have gone through so many emotional cycles that they either sold too early, held too long, or done nothing, paralyzed by the noise. A person who thinks about silver as a monetary principle is asking a completely different question. They're not asking when to sell silver. They're asking when it makes sense to exchange silver for something more useful. These sound like the same question. They are not. The person asking when to sell is thinking in dollars. Their profit and loss is measured in dollars. Their benchmark is the dollar price they paid and the dollar price today. Their success or failure is denominated in the same currency, whose debasement is the primary reason silver goes up. The person asking when to exchange is thinking in purchasing power. They are thinking about what their silver can buy: a house, a business, a productive asset, years of financial independence, and whether that exchange makes sense relative to where those assets are in their own cycle. In 2011, when silver hit $49 per ounce, a person who was thinking in dollars took profits and converted back into cash. A person who was thinking in purchasing power asked, "Can I exchange this silver for a house or a productive business at a ratio that represents genuine value?" And in 2011, the answer in many markets was yes. Silver had appreciated so dramatically relative to real assets that the exchange ratio was genuinely favorable. But most people in 2011 did not make that calculation. They sold silver for dollars. Then they held the dollars. And then they watched as those dollars were slowly eroded by inflation over the following years, while silver consolidated and then began the next leg of its bull market. This is the Talmudic principle applied in reverse. The Talmud says hold 1/3 in liquid, tangible wealth, in silver, in kesef. It does not say hold 1/3 in silver forever, regardless of circumstances. It says maintain a balance, maintain the position. And when the ratio between your silver and other real assets reaches a point where exchange creates genuine value, make the exchange, not into dollars, into land, into productive assets, into things that have intrinsic value independent of the currency. The three-mistake framework gives you a complete picture of why most silver investors do not capture the returns the market is capable of delivering. They own paper silver instead of physical silver, so they get margin called and stop-lossed out of their position at the worst possible moment. They stack without conviction, so they sell during corrections that are the entry points for the next leg higher. And they think in dollars instead of in purchasing power, so they convert their silver back into the debasing currency instead of into real assets at the moment of maximum silver strength. Avoid these three mistakes, and you are not just a silver investor. You are practicing a 2,000-year-old principle of wealth preservation that has protected families through every financial crisis, every currency collapse, and every empire fall in recorded history. The next bull run in silver is not a question of if. The structural deficit is real. The industrial demand is accelerating. The monetary case is intact. The central banks are buying gold at record levels, and J.P. Morgan has noted that government stockpiling of critical minerals, which silver could be folded into, is becoming very topical. Germany is removing silver from its coins. Russia is buying silver strategically. Iran is cracking the petrodollar. Every structural driver that took silver from $29 to $121 is still in place. The price is sitting at approximately $73 per ounce right now. That is a 40% discount to the recent all-time high. Inside a structural supply deficit that is in its sixth consecutive year, with industrial demand growing from every direction simultaneously, with every major analyst projecting a return to triple digits, the next bull run is not starting from scratch. It is resuming from a correction. And the people who understand the three mistakes, who hold physical metal, who have real conviction, and who think in purchasing power rather than paper profit, are the people who will capture what this market is about to deliver. Do not make the same mistakes again. This is the Bullion Rabbi. Stay sharp, stay informed, and protect what is yours.